wanted to see what was going on with the May jobs reports because we know that jobs have been dropping, and I said June, July is when we'll really start to see it. Oh shit! My guys at Dumb Money, they talking about the Trump Elon thing. I gotta check that out. But for now, we'll check this out. Hold on 1 second. See what the jobs reports are talking about.
Of the labor market data this morning showing perhaps a slowing but not a slow labor market. How concerned are you then about the inflation picture going forward?
Well, first of all, thanks for having me here. Mm-hmm. The jobs data is telling you that this economy is prepared to take a licking and just keep on ticking. We think businesses have learned from past business cycles that if they let people go or they pull back on investment when the economy softens, that those people they're scattered to the winds, those investment opportunities are gone, and then when the economy recovers, it's really impossible to bring it all back. You've given up market share permanently to make this tactical choice. So businesses have been gritting their teeth through the tariff uncertainty and holding on to their people, which sets us up really well for the resolution of that uncertainty in the coming months and a continued economic expansion. This is one of the risks, the nonlinear risk the Fed had been worried about was a recession. The other risk the Fed had been worried about was the entrenchment of high inflation into the economy and making inflation persistent. And the jury's still out on that. We probably won't learn much about how much inflation we're going to get or how sticky it's going to be until the late summer, which is what the Fed has been telling us today through a Wall Street Journal, a sourced Wall Street Journal article suggesting that they're on hold potentially past the September meeting. Yeah. And that lines up with the idea that they're going to take their time, focus on which of these two risks is dominant, and then make the right choice from that.
And James, I also want to bring you into the conversation. How does that impact your framework for thinking about U.S. stocks over the course of the second half of this year if the Fed is going to hold for longer?
Thanks, Maddie. And James, I would agree with you. I think this thing is much more resilient than anyone thought. With all the headwinds of tariffs and less fiscal spending, we've got this really tight labor market. And we would suggest that the economy's got to decelerate at some point given these headwinds. And as a stock investor, well, make sure you're really sector selective. What kind of industries and sectors would do well, maybe in a little bit of a softer environment. I think the AI trade still works because that's a theme that sort of transcends any of this tariff or headwinds of fiscal lack of spending. But we think markets can churn higher, particularly you can see today. Good news is good news today, and markets are up.
Is there a second best when it comes to tech? Obviously, tech is the best and has continued to be the best for the past couple of decades here. But what sectors are you looking at that are maybe a little bit more defensive for folks who are worried about that risk?
Yeah, I think there's a lot of value in select healthcare companies like McKesson or Intuitive Surgical, the robotic device. I think consumer staples, Costco had fabulous numbers. Walmart had fabulous numbers. So sort of stay in those more defensive areas. I also think investors should look overseas where you have the opposite economics. There you have fiscal stimulus and easy money, easy monetary policy. And that's why those markets are up a lot more than they are in the US. So different economic climate there.
Yeah, but following on your exact point on how the fiscal policy and the monetary policy both play into the macro picture, I'm curious how you are thinking about the totality of policy coming in from the Trump administration. We obviously have tariff policy continuing to unfold, and then we have the potential upcoming tax bill getting through. How are you thinking about the macroeconomic impact of that legislation?
So we're expecting the tax bill to get through later in the summer, and we think that provides broad continuity to the economy. It's a continuation largely of current policy. It's a continuation of the current high level of the deficit. So from a macroeconomic perspective, it's sort of neutral news. Where I think some of the worries are among some investors is about the high level of the deficit and the lack of a long-term plan to resolve it. This, combined with a lot of the other policy uncertainty you noted, has made people a little bit worried about the long-term credibility of fiscal policy, of monetary policy in the U.S. more generally. Yeah. And that's why we've seen the dollar stay at a relatively weak level despite the recovery in risk assets, and why the 30-year Treasury yield has risen so much and why it remains high. Yeah. So I think we're seeing some emergent signs of worry about credibility over the long term. And that's one of the reasons why we think the Fed stays on hold, is the Fed is one of the anchors that maintains credibility in the U.S., and we think they're going to guard that credibility very carefully.
Are we at a point then where the deficit is driving the tape more than tariff policy at the moment, in your view?
We think tariff policy matters more, and we think that the resolution of that uncertainty, as the administration has backed down a bit from brinksmanship and has shown more interest in making deals, that has been very supportive of risk markets in general.
And James, how are you thinking about the policy coming from Washington and the impact it could have on your investment theses?
I think what I've learned in the last couple of quarters, and maybe over the last 40 years, is that sometimes these policies, they come and go, and obviously this administration changing them on a dime. And go back to earnings, because our job is looking at equities all over the world and look for companies that can somehow plow through this uncertain environment, keep their profit margins higher or normal, and be successful. And I think if you look at it that way, we had this tremendous downside, 20% back up. The only thing that really remained the same is companies had better earnings than people expected, particularly in certain sectors. So I try to tell my team, let's turn the noise down about the tariffs. Let's focus on potential earnings. The economy, like James is saying, does have a lot to do with it. I would agree with James. I think the big risk for equities is a credit default or credit downgrade. In the U.S., we are concerned about that.
How worried are you about earnings growth in the second half of the year?
I'm always worried. My colleagues will tell you I spend half my time being worried and the other half being an optimist. We think earnings can continue to go higher. A lot of companies, particularly if you look at the semiconductor industry, they've not done anything for 6 months other than go down and come back up. So you've got a period where prices have been relatively stable, not going anywhere, but the earnings have gone up. And we think that relates to the second half, back half. You get an increase in equities, less volatility than we saw obviously in April, but we churn higher based on better earnings.
Yeah. So I can tell you that unemployment has remained steady. Economists anticipate that, the unemployment rate, the projections, a slight increase to 4.3% later in the year from 4.2%. With May's job growth at 139,000, slightly below the 12-month average, it's lower. There's people who are expecting it to be 4.5%, but there's some that Goldman Sachs thinks it's going to drop to 3.9%, which is interesting. But overall, what I'm seeing is unemployment is not as big of a factor as I thought it would be. So I was kind of wrong about that. I thought unemployment would be a lot worse, but part of it is because all the pauses on the tariffs, right? All these pauses. Now, we're not safe by any means, but it's a better outlook than it looked like early May, end of April, right? All right. So with that being said, we now have my wife's collection that's created. The tag is hairstyling. So if you go to her product, that's not it. Well, I was at her product. You would have seen, let's go to it. There's her product. Because I already tagged with hairstyling, Shopify has integrated AI, so it automatically will connect the collection that it needs to be a part of. So I'm going to go home and I'm just going to follow their setup guide. It just makes things easier. So let's customize the domain. We're going to add the domain here, connect an existing one, just be curly. I hope it does. It just connects it. I hope I don't have to go manually do this. I hope it automatically does it. Love when they automatically do it. It's Shopify. It should automatically do it. Yeah. You guys see that button? The connect automatically button. So let's click that just in case there's some information y'all shouldn't be looking at. And of course, information you shouldn't be looking at popped up. All right. I clicked authorize. It's 5 minutes, to set up. Can't wait. My wife is going to be very happy. I'd love to surprise her with a finished website by the time she gets home, which is in 1 hour. But I got to take my kids to basketball in about 45 minutes. So I got 30 minutes to finish this. Can it be done? Can it be done? Amazon right now is waiting on identification verification. So if you guys have been following me, then we have Amazon stores that do 7 figures and a couple of them. And we're starting a new one, but you have to do this identity verification. And last night, this shit was glitching like crazy. So that's the bottleneck for Amazon. And I'd like to funnel all of our traffic to Amazon, but because we're waiting on we're waiting on that, and people are waiting to be able to purchase, we got to get the Shopify store launched. It's not what we planned, but it's kind of necessary at this point. So while we wait for this to finish, the provisioning TLS certificate for secure connections, let's check out what else is going on in the world today. Since we were talking about the labor market, let's listen to it.
We take
more.
a look at this report. Nothing to see here. Markets are taking it in stride, albeit with a little bit of a lift at the front end of the yield curve. What's your big takeaway as you do see numbers tempering, but not exactly falling off a cliff?
Yeah, I think the big takeaway is slowing, but still a strong labor market. And I think that's why you're seeing a little bit of the bond market reaction here, pricing out a bit of that expectations in terms of the Fed, but it's pretty close to expectations, a little bit on the high side. I think the wage number is kind of the most interesting thing. It doesn't seem to be affected by the wage week. So, this is part of the strength coming into it. But I smiled when you asked the question to Stephanie, what is really the forward-looking outlook here for labor markets? There'll come a point where we'll talk about labor markets and this labor market report, and it will be validating a trend that we may be concerned about. And that will be told to us first by what's going on with profit margins. Absolutely agree with that point. It's really the pausing point that we're at here with this market report, not really moving us either confirming the concerns that we had a month and a half ago around a recession or validating the response in financial markets that, the peak of uncertainty is over. I think we're still in that uncertainty environment, and the data still that we need to validate whether or not which way that economy is going to go is still in front of us. So this is a little bit backward looking and lagging to answer your earlier question to Stephanie.
So Jeff, let's say we're sitting here in a couple of months and maybe payrolls growth are still slowing, but holding in somewhat okay. What would be the driving factor? Is it the reconciliation bill? Is it that tariffs are having less of an impact? What's the upside story to the economy here?
Yeah, and I think it's what you were highlighting before about whether or not this is the peak uncertainty is behind us, and its impact on decision making is not as great as we might have feared in the middle of April. And so I think that's really the determination: is what impact does all this uncertainty, which I think we still have. We haven't resolved a lot of that uncertainty. We could debate that point, but really it comes down to not what do we think about the uncertainty, but what do we do about the uncertainty? Do we press ahead and just make decisions, make investments, hiring, as if nothing had happened? Or is there a cooling effect on all of those decisions, whether they're on the business side or on the consumption side? That's what's going to drive that economy. It's going to drive the consumption side in terms of demand, and it's going to drive business confidence in terms of what we see in terms of investment. And that's, I think, what the narrative is going to be 2, 3, 4 months from now.
Well, do you think the business community will just keep treading water? How do you make those decisions? I mean, just moments ago, Peter Navarro, a trade aide to President Trump, is telling reporters that the China meeting is expected in 7 days. So in a week's time, we could be dealt with a fresh blow of uncertainty, Jeff.
Yeah, I think the honest answer is we just don't know, because the new data that's coming out, whether it's the challenges from the legal perspective, whether it's the change in terms of the negotiations, what is actually in those negotiations in terms of how much they relieve the uncertainty, we just don't know. And I think there is a cooling effect in the interim. It doesn't show up because the data is still lagged, so it'll show up in the next couple of months. So I just think we don't quite know on the trade impact.
Given the lag, do you think then the Fed is going to be behind the curve? I mean, Elon Musk, an insider who's now on the outs, was saying yesterday that Trump's tariffs will mean a recession in the second half of the year.
I think the Fed has been very clear in their communications that the headline is wait and see, and that the economy's in a good enough position where they can adopt that approach. I think if there's one thing to this report today, it kind of validates that approach, right? We're not seeing an aggressive move in terms of the slowdown impact in hiring in the economy. We're not seeing a huge acceleration. I do think there's some strength, some lingering strength there in wages, but not enough to really press on the inflationary concerns. And so the Fed's in a good spot here to wait and see. Will they be lagged? Yes, this is kind of the, impact of moving from forecast dependence to data dependence, is that the Fed has to be reactive. And so they'll be lagged. The issue for the markets will be, will they aggressively catch up if they are indeed, behind the curve in the event that the trade and tariff uncertainty, leads to a bigger slowdown? Then they're going to have to get more aggressive. That's not priced in to the bond market, as we were talking about. It's only 1 to 2 cuts because it's not yet showing up in the data.
You know, I want to take a step back and talk about what you and Stephanie both brought up, that this labor market information isn't necessarily going to be as tradable as some of the earnings data that we get with respect to profit margins. And I wonder if there's something of a paradigm shift where we were so data dependent and every economic indicator that came out for the past couple of years was a huge tradable moment that was going to give some sort of insight into what the Fed would do. Is that era over? And are we now earnings dependent? Not necessarily when it comes to figuring out how much money they're making, but what companies are doing with what we're hearing about in the mess in real time in a way that this data cannot tell us anymore, Jeff.
Yeah, I mean, there's a long history to the payroll report in terms of moving the bond market. Has it lost some of its efficacy? I mean, certainly, we've come out of this period where inflation has been the bigger driver. Clearly, that has been the story of the last couple of years. And so the payroll report isn't really the kind of preeminent data release on inflation. It has an important component with regards to wages and wage inflation, as I was just highlighting. When you think about kind of the demand side shocks that we typically associate with recessions, the payroll report can be, more confirmative on those trends and solidify the expectations for the Fed. That's where the linkages and the importance to the bond market comes from. But when the issues are more supply side, and we can kind of think of tariffs and the tariff shock as more of a supply side. It has both elements of a supply side and demand side. But when you think about economic shocks driving financial markets that are more from the supply side, yes, the labor markets kind of lose their primacy of being kind of the preeminent data release that we focus on.
Sheesh. Sheesh Louise. Yeah, so everything is up quite a bit. The 30 years at 4.75 as far as government bond yields. CPI is coming up in a few days, so we'll get an understanding of inflation. Yo, so my favorite investor is talking about, what was he talking about?